Good morning friends, welcome to The Point. In this video, we will be studying about a tool used by RBI to suck liquidity out of the economy, which is called Standing Deposit Facility. So let us start with what Standing Deposit Facility is. So as you all know that it is the RBI's responsibility to regulate the money supply in the country. So to do that, RBI uses one of the arrangement called Standing Deposit Facility. So what it does is, it is an arrangement where the RBI absorbs excess liquidity from the market. So the purpose to use SDF is to absorb excess liquidity from the market from the commercial banks without giving any securities in return. So I'll give you a brief introduction about the background. So whenever there is excess liquidity in the market, so what RBI does is, it sucks out the liquidity by increasing either the CRR or increasing the reverse repo rate. Okay, so in case of reverse repo rate, what attracts the bank is the interest rate goes up and banks are now more attracted to deposit the money with RBI than to create loans and give it to the normal citizens in the market. I'll explain it with an example. Let's suppose there's HDFC Bank and it has some money with it. Okay, now it has two options, either to give it as a loan in the market, or if the interest rate offered by RBI, if the HDFC deposits money with RBI is good or is attractive, then obviously HDFC will go to RBI and deposit its money with RBI and earn interest rate over it. Fine. Now this is called reverse repo. Okay. Now whenever HDFC banks goes to RBI to deposit money on reverse repo rate, what HDFC gets in return is securities as collateral to the deposit made by it to RBI. Now so there is a limit to securities held by RBI. So imagine a case where all the banks are rushing to RBI to deposit their money. Let's suppose SBI comes in, ICI is there, PNB comes in, and all of them are depositing their money with RBI. Now the securities which were given as collateral by RBI stands exhausted. Now if RBI wants to absorb the liquidity, what will it do? Now it will resort to Standing Deposit Facility. It is a facility where RBI absorbs the liquidity, that is the SBI, ICI, PNB will come to RBI with their money. RBI will keep its money, also provide the interest rate. The only difference is that the collateral securities which were provided in the case of reverse repo will not be provided over here. I hope it is clear. Now we will read whatever it is written here. So in routine, when the commercial banks have extra funds, they deposit it with central bank and earn an interest rate called reverse repo rate. As I told you over here, HDFC went, deposited money on the interest rate called reverse repo rate, and in return got securities from RBI as collateral. Okay. So when the money is parked with central bank, it gives collateral for the money deposited, which is not in the case of Standing Deposit Facility. So it is basically collateral free deposit. On to the next slide. What is the need for for this facility? Now what happened was, when demonetization occurred in 2016, there was a lot of cash with the banks which flooded in. So what banks were doing it, so this is banks, and a lot of cash came in, and so what was banks doing it, the money lying idle, so they actually started giving the loan in the market at a very less interest rate, so that the money can be put to use and they can earn something on it. So what they did was, they reduced the interest rate, and interest rate also went below the repo rate as given by RBI. So RBI then decided that as all the collaterals are exhausted, so we should come up with a new mechanism in which collaterals are not to be provided. Hence, they came up with this facility called SDF. It was first recommended by Urjit Patel Committee in 2014. This is something extra which I am telling you, and it got passed in 2018 budget with a financial amendment bill. So now we'll read. Post demonetization, the banks were flooded with the funds, due to which interest on loans also slipped. Too much fall of interest rate also hurts the market sentiment, as there is so much disbursement of money as loans that the inflation started picking up, which RBI never wants, that the money being cheaply supplied and inflation rate picking up unnecessarily. To prevent such a situation, RBI came up with new mechanism, as RBI didn't have much securities to give as collaterals in reverse repo rate system. So this was introduced in 2018's budget to absorb the excess liquidity from the market. By this, RBI ensured that the interest rates do not fall below the repo rates. I hope it is clear. Okay, now we'll understand what is the difference between the reverse repo and SDF. First of all, I'd like to tell you what is repo rate. Repo rate is the rate at which commercial banks borrow from RBI. So here is RBI. Whenever RBI gives loan to commercial bank, it gives at repo rate. Okay. Now when commercial banks deposit their money with RBI, that is at the interest rate called reverse repo rate. I hope it is clear. Now here collaterals are given, and here also collaterals are given. Now what is the difference? Collaterals are provided by the RBI when money comes in under the reverse repo system, whereas there is no need of providing the collaterals in the case of standing deposit facility. Also, the interest rate given in the case of SDF is less than what is given in reverse repo rate. So these are the two basic differences between this the reverse repo and SDF. So please don't get confused. So whenever RBI wants to suck excess liquidity out of the market, it increases the reverse repo rate so that the banks do not create loans in the market and gets attracted to deposit their money with RBI, and in return they get collateral securities as security amount. And the difference lies between reverse repo and SDF is that the same way when RBI wants to absorb the liquidity from market, it gives interest to the banks depositing money, but without the collateral securities being provided. Also, that the interest rate given on SDF is lesser than what is offered on reverse repo. So this is all for the today's video. I hope everything is clear to you by now. Thank you so much.